Hello and welcome to Market Outlook for the week of August 28th. This is Jeff Bish, president of MarketGauge.com, filling in for Keith. So if you listened to last week's Market Outlook, the main theme was that the internals were breaking down, but the markets were at a little bit of a stretched point. Now, this week, not a lot has changed in terms of the market internals. We'll look at that. But the compression of the market has definitely changed. And as a result, I think it's really straightforward in terms of what we're going to look for the next major move. That said, we're in the last week of the summer. First week in September. Both of these weeks could be pretty slow. So compression during these weeks got to be a little careful of. That said, you got to go with what the chart says, and that's what we're going to do. So the compression I'm talking about is the SPYs having spent the last 3 days inside of Tuesday's rally. Now, it's unusual enough to get 3 days inside a prior day, especially when the prior day isn't really all that big. However, when it also happens right on a 50-day moving average, that makes it even more significant. So from the SPY's point of view, whichever way this thing breaks, I think you're going to want to follow it. Now, of course, we always want to look at more than one index. And if we go to the Qs, it's pretty much the same thing over there. Now, Thursday did take out Tuesday's lows. But for all intents and purposes, you've got 4 days of really well-defined consolidation sitting on a 50-day moving average. Whichever way this goes, you want to follow it. In both cases, the real breakdown really happens under last week's low. So expect some support down there, but if you break that, then it does look pretty negative. And if we go down to IWMs were the worst beaten up. But if you remember from last week, and even if you don't, let me zoom out here. We'll make sure that we're paying attention to the fact that IWMs are really down at a big support level right in here. So they didn't consolidate this week. They actually worked their way back up, but this green line is the 200-day moving average. Can't seem to get back above that, and it would be natural to expect them to stop right around this consolidation where they are. This is a big inflection point right in here that they would have to get through on the upside. So IWMs still, I would say, caught within a range at the bottom of a bigger range. So if the market's going to head higher, I'd expect to see Qs and the SPYs to break out of this 4-day range, and I'd expect the IWMs to at least continue to work their way higher. If the market's going to move lower, I would expect the IWMs are going to break this low from last week, as are the Qs and the SPYs. Now, if the market's going to move lower, then I would also expect the TLTs to really start to accelerate to the upside. And the reason I say really start to accelerate and not just move higher is I want to just point out a pattern that's going on here. And that is that since the beginning of August, stocks have basically been in a slump. And bonds have been quietly moving up. So I'm not sure why the bonds are moving up. I don't know that we can really blame it on the stocks, but certainly it does imply that some nervousness there. Real motion, maybe I'll show that indicator later, has been bullish on the TLT for quite some time. So that to me puts a kind of a bullish hidden trend underneath this thing. So if the stocks really start to sell off, then I think you'll see TLTs really start to accelerate higher. So I think it's really that straightforward looking at the big picture. Now, if we pull in our, take a look at big view. I want to also point out a few things that would support the fact that if the markets start to head higher, so if I'm just down, I'm just here at big view the way you would get here. Go to tools and then big view. This part in here is free, and you see the indexes with the real motion on the bottom. Now the real motion, if you don't have it, here's just a quick heads up on what to look for. The blue line and the green line are the 50 and 200 day moving averages of this momentum indicator we call real motion. It's proprietary. And those things should really be in sync with the overall market. And when they're not, it's a heads up. So you can see how the dots, which are a really short-term measure of the momentum, have been under their 50 and 200 while the SPYs have been above it. And so that's negative, and that continues to weigh on the market. The blue line is now under the green line, the 50 under the 200 in momentum. So that is a real negative for the SPYs. It's not necessarily so timely that that's the day we're going to sell off, but this will continue to weigh on the SPYs, and that is a reason to believe that if the SPYs break down below this level, it's a dangerous situation for a significant decline. You can see if we look at IWM that the momentum has been crossed to the negative most of this year, and IWMs have struggled, and IWMs are the weakest, and that's all kind of indicative of that real momentum. Now, if we look at it on a weekly basis, however, we could look at it as either a potential positive or continue to look at it as a pretty significant negative. And the reason I say that is the weekly 50 here on the SPYs has been support numerous times in real momentum, and that's where we're sitting right now. So if it breaks and the price breaks, that's really negative. But what this does support is if we break to the upside of that box I just described, then we're also bouncing off some support in the real motion momentum indicator. And the same thing could be said for the Qs here. Same thing cannot be said for the IWMs here. IWM has broken its blue line, and it's sitting right on, and now in this case it's the 50-week, so it's sitting right on that 200. This should not be under this line, so that's the negative on IWMs. If that continues to break, you don't want to trust that 200 is really going to hold if we continue to break. All right, so the weekly picture does support the idea that if momentum or the price action does start to head higher, there is some longer term momentum behind it, but the shorter term momentum in the markets right now is still pretty heavy. So you got to go with price action, follow the price action. And that's why we go to the market internals to try and see whether or not there's some other reasons for the market to bounce or to hold here. Now I'm going to jump right to the market internals and the McClellan. All right, so if we look at up-down volume and advances and declines, they're basically nowhere. All right, I want to see them at extremes. With the price at extremes, they're really nowhere. And I could say the same thing about McClellan, except for one thing. McClellan now is kind of well over that 50% mark, which it is on the bullish side of McClellan. It doesn't necessarily, again, it's not timely, but what it does suggest is not, when I say it's not timely, it doesn't mean it has to, just because that crossed, today's the day the market's going to go up. But if you're on the upside, or above the 50 line, it's generally bullish, right, until you get overbought. So again, we're not going to be long just because McClellan is bullish, but if we break the top there, this supports the fact that the advanced declines are not overbought. McClellan is bullish. So what do we do now? We have a bullish bias, and we wait to see whether or not everything kind of kicks in gear with the market internals. So what do I mean by the market internals kicking in gear? Well, let's quickly first take a look at this same chart on NASDAQ. And you'll see that it's basically the same, right? The up-down volume and advanced declines really aren't anywhere to be noteworthy. And McClellan just poking its head over the 50% line. So there again, if we move higher, great. If we move lower, there's not much here that's going to mean much. But the way that things could kick into gear is over here on the new high, new low ratio. So last week I talked about the fact that it's negative because we've broken down below the 70 level. The trend is negative, and we had kind of expanding new highs. We had divergence at the highs of lower number of new highs as the market was making a new high. Not what you want to see. But if the market's going to move up, what you do want to see is the number of new highs start to expand to over 100. Now, we're not quite there yet, but this is what I would look for if we start to move up. If we break out, look for the absolute number of new highs here to continue to break up. So the bulls would say, look, we got a decent amount of new lows here, so maybe we scared enough people, we can go back up again. It's not a big flush. So if it starts to go up, this has got to expand. If the market goes up and these numbers don't expand, that is a big warning sign. It takes a little time because this is a 10-day moving average for the trend of this thing to actually move up. So in the case of the line here, yeah, if the red line crosses the black line, this is a shorter term moving average. It's an indication we're going in the right direction. But big picture, it's really not very bullish or very bearish either way. It's just a confirmation of any bull move higher if it expands. If we do the same thing on NASDAQ, we're going to see basically the same picture. We haven't gotten washed out. Getting washed out would mean this black line comes all the way down under the 30% line, and we're not even close to that. New highs, we haven't gone down, and they're at least edging higher. But again, if NASDAQ breaks higher, you want to see these number of new highs break well over 100 as well. Otherwise, it's a weak rally. And for all the reasons that I've just illustrated, we'd want to be careful. Now, there's one other area here in market sentiment where we've got an interesting situation on the market internals. And that is, if we look at the number of percent of stocks in the S&P that are over or under their 10, 50, and 200-day moving averages, there's an interesting pattern here. So the interesting pattern is that the 10 got down pretty low. So the magenta line is the percentage of stocks under the 10-day moving average. It got pretty down to kind of oversold levels. When the SPYs made a second new swing low, there was a little bit of a divergence there. Not a huge one, but I would call this kind of like a double bottom in this particular indicator. And now it coming back up over the 50% line, if it starts to move higher along with this box moving higher, that's telling you, kind of like the number of new highs, that you've got an increasing and a healthier number of stocks that are back over their 10-day moving average. And that is what you want to suggest that some of the trends that have pulled back are reemerging. Now, the blue line is the 50-day moving average, and I'd like to see that one come back over the 50 level too and start to trend higher. Again, this won't happen necessarily overnight, but if over the course of the week these things improve, that would be great. If they don't improve and the market's moving higher, that would be a big warning sign. All right, so last week I just kind of give you a heads up on the gauge. You can see the gauge is still negative. Yes, it's moved to less than completely 100% negative, but it's still pretty negative here. There's nothing here, in my opinion, that's really changed the gauge's negative view. So this time around, I thought I would highlight in the risk on, risk off section, just kind of the value of this market hotspots page. So this is free. You just go to risk on, risk off, market hotspots. And one of the things I wanted to point out for you is that, especially on the weekend, if you take a look at this 5-day leaders and 5-day laggards part of the hotspots, it's basically telling you, hey, what was hot this week? And you can also see it in the context of the last 3 months and 6 months. Now, it just so happens that we've got some interesting stuff here. Now, I know Keith has been focused on copper for a long time, so I guess not surprising you would see it here. And if we look at 3 month and 6 month, you can see that that's been the trend there. But China, I don't know if you've been following China, but if you haven't been following China, then this should give you a heads up 5% on the week, and 3 months up 11%, 6 months up 13%. Now, I've been following it for a while, but we're going to go take a look at that chart, and you'll see why in a second. And sugar. So sugar might not be something that's really on your radar, although Mish, if you're following Mish, is usually all over the commodities. But the interesting thing about sugar is up 5% and clearly this thing's in a downtrend. All right, now when you go look at the chart, and I think I will for you depending on how much time I've got, you'll see that it really looks like there might be a potential double bottom there. And I just found it by looking at what was hot this week to see if there's anything that really jumps out. If I look at the 5-day laggards, there's nothing here that's really jumping out at me, with the exception of a heads up, which you're probably already seeing, which is VIX. The market didn't do much this week, right? But VIX did get hit pretty hard, which would suggest that the spike in fear from the last 2 weeks is really cooling down. So it's a nice heads up. Now, the other good place to check out every week, if not every day, would be where are your 6-month leaders and what are they doing? And in this case, I would look, because we're talking about this on the weekend, you've got this 5-day, like what was hot or not last week? And again, just like the 1-day, or sorry, the 5-day, how is it relative to its bigger trends? So the thing that I see that's jumping out here is the things that were hot this week have been hot for 3 months and 6 months. And it just so happens that they're all foreign stock indexes, right? So if that trend isn't jumping out at you already, this page could easily point you in that direction. If we go look at what's not so hot over the last 6 months, so these are the worst performing ones over the last 6 months, and they're kind of mixed. So last week, I wouldn't say there's much of a change. Coffee's been a real bomb and it continued to lag. XOP not up that much and been a lag. OIHs interesting. And in fact, OIHs are at an interesting spot. So we're going to go take a look at that. And in fact, actually, I looked at OIHs as a result of this, because they've been so bad, and I got OIH and XOP modestly positive, so maybe there's something going on there. And then sugar again. So my point here is that just a quick look at this to be able to see if the 6-month leaders continue to lead. They did. The 6-month laggards are continuing to get hammered. No, not all of them. So some of them might be worth a look. All right. So before we go on and look at those, the other place that I always want to take a quick look at and would suggest you do too is the sector summary. And we talked about this last week, I believe. The total accumulation of sectors here continues to erode. So this is not good, but it's not overly bearish either. And I'm not going to overanalyze that one. However, if we go up here, there are a couple things. I don't necessarily think they jump out at you by this table, but there are a couple sectors from here that I think we are worth noting just as ideas for the week going ahead. All right, so one of the things that I would do with this table is keep an eye on the leaders. Now, just as a refresher, this table is telling you is ordered by the 6-month percent change. So what you want to see is a week where your leaders, the top of the table, is green. In this case, it is. And you also want to see the most green in the 6-month column, which obviously that's not the case anymore. That's creeping in. That's what we see in the chart below. That's what's reflected in this chart here. The one thing that does jump out here for me is that you've got XRT had a good week, even though it's been bearish. Now, if you've been watching XRT, you know that thing has just been taken to the woodshed. So the fact that it's up 2.9% this week, in a week where the SPYs are only up less than 1%, that might jump out at you. So we're going to take a look at a couple of sectors here that are in warning phases, and we'll take a look at some of the sectors here that are the leaders that are doing well, see if there's anything up. And I'm going to do that in a view where I can see both the triple play and the real motion indicators. So if if you have real motion, or if you have real motion, some of this will make sense. If you don't have real motion, this is the same indicator that I was talking about in the beginning that measures momentum. And triple play, I just did a live training on it this week. I'll put a link to that live training below this video. That'll only be up though for the weekend. So here's FXI, and this is the one that we saw on the 5-day. The 5-day chart. And the reason that FXI is so interesting is, and I know it's kind of hard to see here, but here's the 44 level. And if you look in Mish's Daily, I wrote Mish's Daily. So we've now broken out over the 44 level. And because of this in here, I think this is a really a significant point that if it continues to hold this level, I think this really represents a beginning, a ramping up of momentum. Now, certainly it could fall back and head lower, but that's easy enough to see happening. And I would say that starts to happen as soon as you start trading below, say, the 43 level. You know, be careful if it pulls back in there. But if it can hold above 43.50, 44, this thing looks like it is really ramping up. Now, real motion would suggest that this has been building for a long time. So you can see, once again, the blue line is back over. It's like the 50 now crossing over the 200 in terms of momentum, even though the price has already been there. So real motion is definitely in agreement with this move higher. So I boiled all that down to China is hot. It could very well stay hot, and on a pullback, you probably would want to pay attention to it. So let's take a look at sugar. So this was another one from that hotspots page. And the thing I want to point out, so this is for, if you have real motion, this is a pattern you really want to watch out for. And that is, you can see that sugar put in a low here, rallied up, tried to take out its 50-day moving average, pulled back down here to kind of match that low. But look what the real motion did. Real motion broke its 50 just like sugar did, but when it pulled back, it held the 50. So this is a real motion reversal pattern in progress. So we always trade the price, so you want to see sugar come back over its 50-day moving average, or back over its 10, depending on how quickly you want to trade it. But the way sugar lines up right now is pretty nice in terms of this 30 level has been pivotal. That's going to pretty much correspond with a confirmed move, confirmed recovery phase, close back over the high of the day that closed over the 50-day moving average. Basically, we're confirming the move back over the 50. So one of the ways I'd look at this is time to get long and stop under the 50, and you've got real motion kind of giving you the wind at your back. So sugar's kind of volatile, but if you're interested in toying around with commodities, this is one that you might want to pay attention to. All right, so let's take a look at some sectors. So let's just take a quick look at the hottest sector. So SMH. SMH, if we start down here with real motion, you can see that this is a drag, right? You got the 50 under the 200. You got the daily under the 50. This is a total drag. If SMH starts to sell off, I'd be really careful. However, the triple play here is modestly positive, right? So it's still struggling to be a leader, which is this price performance. Blue over red indicates that it's a leader, red over black, a longer term leader. So in this case, that's good. The volume here, struggling to turn positive again. So triple play is not all that positive right now, but if SMH can break above this kind of channeling lower, it could resume its leadership role. It's definitely in a position to do that. So SMH, I'm not really all that thrilled with it, but the end result is, just like I said with the markets, if it moves higher, definitely has some room to run, but you got to make sure that you keep an eye on that rally, because if it starts to peter out, it wouldn't be surprising. On the other hand, if it starts to head lower, we definitely want to get out of the way of that one. So where might we go if that's not looking all that great? I would rather be focused on XLKs. Just a different version of technology, right? So you can see that if we start with triple play actually looks good in terms of price action. It's been really strong through this whole consolidation. The other thing, I've got the Bollinger Bands on here, so you can see this, which is it's squeezed. So this thing is definitely got tight Bollinger Bands, and so when that happens, when you break to the upside, especially if you have triple play going in that direction, that's the way you want to see it break. All right, now triple play isn't going to guarantee the break higher. And if the market goes lower, I'd expect this to go lower. But if the market goes higher, I'd look for XLKs to be a leader. Now the volume here, for those of you who saw the triple play training, you know that this is not what you want to see. But volume oftentimes in the ETFs, especially on the highs, is hard one to trust. So I would, if it moves higher, like to see the volume move up, but I'm not going to discount the breakout because the volume isn't there. One thing that is a warning, though, is that if it moves higher, we're going to want to see real motion really pop. I'm going to want to see the 1 day, the dots, right, really short term, breakout above these resistance levels. Why? Because you can see the momentum in this thing is definitely kind of falling. And that's the same thing I was talking about last week. The internals, the momentum of the market is definitely rolling over, but there could be another move to the upside here. We know where the inflection point is. If it happens, wouldn't be afraid to follow it. Now, on the bearish, like heads up, watch outside, we have XLYs. So XLYs are sitting right, and these are in a warning phase. That's picked this off the sector page because they were in a warning phase. They're sitting right at this support level here. They can't seem to get back over the 10-day moving average. The triple play is negative, which means if it breaks support with a triple play that looks like that, you don't want to trust it. The real motion has already broken down. The longer term on real motion is breaking down. So XLYs, you want to stay away from if they break down. Don't trust the 200. If it gets to the 200 is kind of how this works out. And you can kind of see this has been coming, right? Because when XLYs broke out to the highs here, real motion couldn't even get over its 50-day moving average. As soon as it pulled back, it started to fall. As soon as it pulled back, its triple play started to fall. So whether you were using triple play or real motion, the pullback on XLYs, especially below the 10-day moving average, was already telling you this whole breakout is just a breakout waiting to fail. So on top of that, now you're sitting at the bottom of the range and everything is continuing to get negative. So those are several ideas you might want to watch out for during the week, and this is how we put together the big view with the other products. I hope that helps. And remember, last 2 weeks of the year, or last 2 weeks of summer, don't get too crazy with over trading, but it doesn't mean we couldn't see some nice moves. Hope that helps, and we'll see you in the next video.